My guest today is Rafael Quinn. Rafael is a co-founder of Alternative Holdings, is a diversified holding company. They operate in 5 different verticals and have done 8 acquisitions, 100 million in revenue with 1,000 plus employees. They operate in Panama and the United States. Thanks a lot for coming to the Holdco Builder show, Rafael.
Thank you for having me. It's a pleasure.
You're an excellent person to talk to, as you are building exactly what I'm trying to do here in Europe. You buy companies you understand. These companies are run by people you want to work with, and you want to do it all by paying a fair price. We will get into that very soon. But while being 26, you sold everything you own and moved to Latin America.
That's
this
correct.
is a quite drastic decision. Could you please share the whole story in 2 to 3 minutes?
Yeah, so I was born in California. I grew up in California, but my mom is Panamanian. So, my dad is from the US. My mom was actually born and raised in Panama. So her entire family lives in Panama. So it wasn't this massive uprooting going to Latin America. I had a family down here. But I grew up in California. I went to school at UC San Diego, studied economics. I liked business from a young age. I liked the stock market. I worked in asset management on the sales side. The last job I had in the US was actually at a company called Fisher Investments that's based out of San Francisco. And at 26 years old, I made the decision. It was really a quality of life decision. I have a lot of cousins in Panama. I was envious of their quality of life down here. I really love the country. I love the culture. So like you said, I put everything on Craigslist and hopped on a plane and moved down. I still remember that when I put everything on Craigslist, you're just trying to sell everything. So everything was literally listed, right? And about one day in, a guy comes to buy my couch, and he walks into my studio apartment, hardwood floors, and he goes, "Hey, I'm going to take the couch." Great. And he goes, "Hey, is the bed for sale also?" And I was super excited because these were 2 of my biggest items I was going to sell. So of course it is. I'll help you carry it down. So we load his pickup truck with a sofa, load it with a mattress. And I walk back into my studio apartment, I look around and I go, damn, where am I going to sleep for the next 15 days? Because my flight doesn't leave for 15 days. So I literally slept on a hardwood floor in a little sleeping bag. I was still working as I wrapped everything up there. So yeah, I moved down to Panama, continued working in asset management. I had a job in a bank in their private banking division. That bank was then acquired a few years later by HSBC. So I had a little mini liquidity event there from some of the shares that I owned in the bank. And shortly thereafter, Alternative Holdings started. We got started on the holdco.
Can you maybe share the initial idea and maybe even the first acquisitions and how it all got started?
Yeah. So, when I left the bank after it was acquired, I didn't have a full-time job. I was investing in essence. Panama back then, this was 2007, 8, 9. It was booming. It was crazy. There was just cranes everywhere, construction boom. The country ran out of concrete at one point. So there were just a lot of opportunities to invest. And as one of those investments, I actually helped raise capital for a real estate development that was happening just outside the city. And the head of that development is my today partner, Lucas. So we met during that capital raise for his project. And, through those meetings, we had a shared interest in Warren Buffett, value investing, the stock market. And I got to give him credit. Really, the idea of a private business holdco was his. He actually found that initial company. So the first business we bought was an industrial distribution business. So we focused on lubricants and filters for motors. And we did it all B2B. So we would sell to transport companies, construction companies, tuna fishing, the Canal of Panama. We still own that business today. So we bought it. It had about 20-something employees, 2 locations. It had been around about 10 years. And I remember what attracted me to that business was we were getting it at about 3.5 times earnings. And I was used to seeing a stock market where things were trading at 15 to 25 times earnings. So to me, 3.5 just seemed like this great deal. I didn't know anything about lubricants, to be honest. I mean, I understood the basic need of lubricants in a motor, but I didn't know much more than that. So, Lucas and I partnered up. We acquired that company. It was shortly thereafter that we made the decision, about 6 months in, that we really enjoyed owning a private business. We wanted to use that capital to acquire other businesses. And we formed what is Alternative Holdings, this holding company. Unfortunately, we weren't much of a holding company because we only owned one business. So that's how we started.
So if it's not a secret, how much money did you have when moving from US to Panama? Because I think this is oftentimes something which holds people back of actually
Right. Yeah. And
acquiring.
when I moved to Panama, I didn't have all that much. I was very lucky in the sense that my grandparents and my uncles and aunts lived down here. So I actually lived with my grandpa when I first moved. I had my salary. I wasn't sitting on some big nest egg when I got started. I did get a decent amount of capital when the bank sold, $150,000, let's say, which to me back then, being in my mid 20s, was all the money in the world. That first acquisition we did, I would say we were more lucky than good back then. We took on way too much leverage on that deal, and that deal could have gone bad very easily. If I probably was going to recommend somebody do it again, I would have bought something a little bit smaller, not taken on as much leverage, and not had that much risk. We were very lucky in the sense that business performed the way we needed it to perform, and we were able to deleverage relatively quickly.
How hands-on you were on the first deal? I mean, running the business post-acquisition.
Yeah. So when we start Alternative Holdings, my partner and I, we had two core concepts, and these have evolved over time, but we still abide by them. Number one was neither of us were going to work in the companies. So we would not be operators. We don't consider ourselves to have any edge or value add against the competition operating a business. We do believe we have an edge investing in businesses and analyzing businesses. And that's extremely important to understand before you get started is, how are you going to win here? What is your edge in this game, right? For us, it's the capital allocation. So we never did work at the industrial sales company. That doesn't mean we weren't involved. I think we were probably overly involved in the beginning, simply due to the fact that we didn't have much else to do. We only owned one business. A year later, we bought our second company, and we still went to every meeting together. We were involved in that sense, but we always had a CEO running the operation for us. We always had that delegated management system in place. That was a core principle of ours from the beginning. Because, the second you step in and start running a company, you're not going to be able to own that many more companies. You're basically making the decision that your future is going to be based on this operation and how fast you can grow it. Maybe you can buy other more vertical integration in that business, but it's going to be hard to go wide, to start buying, unrelated, diversified revenue streams and building what I consider a true holding company. It's quite difficult to do it if you're the CEO of your first business.
Before getting into some of the processes, I want to ask, how has been the partnership over the years, and especially how was the early years? And because I think based on the early years, you made the decision that, okay, let's build this holding company into what it is today.
My business partner is the person I spend the most time with after my wife and my kids. So it's somebody that I obviously get along with, thankfully. And I was very lucky because I was not looking for a business partner back then. None of this was conceptualized yet when we met. I think we have we're much better together than we are. I can't even imagine having done this or built this without doing it with somebody else. And not just for the business side and the results side of it, but just for the fun of it. I mean, we've gone on hundreds of trips, seeing businesses. We've gone to thousands of meetings. We've looked at all these companies. We can sit there and just laugh for a weekend, just telling stories to each other of all the stuff we've gone through on some of these meetings, seeing companies going on trips. So in that sense, it's just been a priceless part of the process for me. As far as the actual how we work together as partners, I would say, and this isn't always the best, we share many of the same strengths. And that's not always ideal. If you could maybe draw this up, which you can't because you don't choose who you partner with, you don't have it all figured out in the beginning. Maybe it would have been better if one of us was the allocator and the other one was the operator. That maybe would have more benefits. We're both investment background capital allocators. In that sense, we overlap a lot on what we do. But still, I think having somebody else to talk to bounce ideas around, just to get a second look on things, has been extremely beneficial. We always laugh. We never wrote a shareholder agreement. When we got started, our only agreement, we owned the company 50-50, was, well, whoever says no wins. So basically, it takes two yeses to proceed. If one person says no, then we just won't do it. We'll just go to the next thing.
I think it's so important And listening your story, you pretty much got so-called lucky in those two things. Your first acquisition was successful, number one, and you found a great partner while doing this.
Yeah, extremely lucky. Extremely lucky. Again, I look back and I mean, I was 31, I want to say 31 when we bought that first company. He was like 27, 28 years old. The only thing we did right on that deal, if I really look at it, is we got a really good price. And that's really important though. I forget, I don't know if it's Warren Buffett or Howard Marks said, price is my due diligence. I mean, if you can get something low enough, a lot of things can go, or cheap enough, a lot of things can go wrong, and that investment will still work out for you. It's not going to sink. So I think we got the price right on that deal. At least that's what we were knowledgeable enough at the moment to actually say we did that right. I look back, there were other things about that company that were very good. Had great client diversification, had a product that is needed in an economy to move forward, lubricants, filters. So there were other things that went well, but specifically we got the price right.
And when I said you got lucky, I don't want to sound like a bad or something. I think it's just so important, and this is the key of you building what you've built so far.
Yeah, I mean, I'm a big reader of Howard Marks. I don't know if you know him. He's a distressed credit investor, and one of the things that he talks about is the outcome is that something works doesn't mean it was a great plan. The outcome is just one of a multitude of different outcomes that could have occurred. You know what I mean? So yeah, I think always luck plays something.
And I once read an interview about Steve Wynn. He's the guy who builds hotels in Las Vegas, and he said, better be lucky than smart.
Right.
Okay, so you and your partner personally look at every opportunity, read each CIM, and visit all potential acquisitions. You delegate the management of your operating businesses to professional CEOs. Some of them were hired post-transaction, and others are founders. How does it all work?
Yeah, I mean, well, that's a pretty good summary. I mean, the one thing that we don't delegate, as I mentioned before, we consider ourselves much better investors or capital allocators than operators individually. Therefore, we don't delegate the investment process. We don't have a team of analysts working here in the office. He and I go through CIMs, which are just, 50-page summaries of opportunities of companies that are available for sale. When we find something that seems interesting to us, we'll sit down with the other one, pick their brain, see if it also looks interesting to them, start doing some of those initial calls, do all the visits, negotiation, due diligence, etc. That entire process we do ourselves. When we buy a business, one of the keys is that there has to be management continuity. So somebody in a position of power at that business has to stay post-transaction. When we first started, that was generally a COO type. They were smaller companies in that sense. So they were generally founder-led, founders looking to sell, looking to retire, but they've got some number two, second in command who's been there for a decade, 15 years plus, and we feel confident we can move them into that kind of general manager position, right? As we moved up the scale, acquiring larger businesses, we found that there are obviously more complete management structures in these businesses. Therefore, you have more options of maybe who could take over that lead role. But we've been very lucky with the people that we've stayed on with post-transaction.
Now, aside from reviewing investment opportunities, each of you acts as a managing director overseeing the performance of holding company and guiding its CEOs. What are the main KPIs you are focusing on when it comes to the performance of the whole holding company, or numbers? What are you looking at? You're in the office, the quarterly numbers are coming in. What are you looking at?
I think there's two different levels to that. One is, what are we looking at the holdco level? And then number two is, what are we looking at individually in each of the opcos, correct? So yes, my partner and I are each managing directors. He oversees our US companies. I oversee our Panama companies. Just real quick, what does that managing director do? They're the point of contact at the holdco for the CEOs. So if the CEO has an issue, if they want to talk strategy, if they want to review budget, if they want to bring a new line of products, who do they call? Well, in the US, they would call my partner Lucas, and here in Panama, they call me. As far as overall financials and KPIs of what we're measuring on the opcos, those will vary by industry. We today do participate in different verticals, is what we call them. So we are in business process outsourcing, industrial sales, furniture retailer, restaurants, heating supply distribution. So while some of the metrics that we'll look at will be similar, obviously, how's your sales growth going? How are your gross margins performing? How's your OPEX going versus budget? How's your inventory rotation going? If you're selling on credit, is that credit healthy? Those things will apply to some and not to others, right? So inventory and credit is not going to make much difference in our restaurants, but it's going to make a lot of difference in our distribution businesses. I would say our overarching KPI, the one that we apply to every single company and that I most focus on, is cash. So I'm interested in how much operating cash flow you are producing versus your net income, right? So net income is derived from your budget, in the sense you're telling me I'm going to hit a sales number, I'm going to sell that at this gross margin, and it's going to cost me so much to operate to achieve that. That gives me your net income. And we'll be tracking that on a quarterly basis to see how close are you to what you promised me at the end of last year. But then more important than that is, whatever that number is, what percentage of it's actually turning into operating cash flow? I think that's where a lot of business owners or holdco owners get stuck, is understanding that, EBITDA is not cash. Net income is not cash. The only thing that's cash is cash. And the reason I don't focus so much on free cash flow, more on operating, is because at the holdco level, we have final decision on major CapEx. Therefore, if there's a big difference between operating cash flow and free cash flow, it's because we've approved some type of investment project that we've already analyzed. And then I'm simply tracking that on a different investment tracker, making sure it's staying within budget, how are the returns going on that investment, et cetera. But it's mainly that conversion of operating cash flow from net income.
Two questions about the holding company level. How many people do you have in the headquarters, number one, and how much debt are you using overall?
Right. So we are very light at our, what I call our corporate level. So we at the holdco. So in this office is my partner and myself. We have an in-house attorney. We have an in-house COO. We have an in-house CFO who actually works based out of the United States. We have an internal auditor. And then we have a personal assistant. So it is a very lean structure at the top. I think if you go back and you study the history of conglomerates or holding companies, the most successful conglomerate holdcos are those that have stayed as lean as possible at the top. They're the ones that have assigned expenses down the operating businesses where they can actually measure it versus a budget and see what it's producing. When you start seeing a holdco get real fat at the top, having a lot of vice presidents and middle managers and bureaucracy, it's usually when they end up, things go bad. So we've definitely tried to model ourselves more on that lean model at the top. What was the second part of your question?
Leverage and debt, how much you're using this?
When we entered we're 30-70, to answer your question easily. 30% cash, 70% debt. However, we structured that in a way, we raised that capital from outside investors for the financing. And those terms, in essence, we gave them a convertible debt instrument. So they loan us money. They can convert up to 20% of the face value of that debt to common stock at a predetermined valuation. And due to that upside on the warrant that we attached to it, the equity kicker, we got favorable terms as far as what would cause a default, let's say. But we go 30-70.
You've been doing this for 13 years. It's maybe a bit personal question. I'm quite sure you worked quite a long hours in early days. I mean, when it comes to family, spending time with family, you probably spent quite a lot of time away from them. From which acquisition on which year you started taking money out, paying dividends to support your lifestyle?
We've never taken a dividend.
Mm-hmm.
So we've never done that. That was actually the second one. I mentioned previously that we had two core theses when we started. One was we weren't going to work at the companies. The second one was we were going to reinvest all of the profits. So what my business partner and I do is we actually draw a salary. So we are salaried employees of the holdco. We live off that salary. It's plenty for me to live the life that I want to live. And in the scheme of things, though, I would consider it's definitely not a dividend. It's not like I'm saying, I'm drawing a salary, which is just a quasi dividend. It's not. Quite low relative to me, the sales or the profits of the holdco. But we believe it's comparable to the value that we add as professional CEOs of the holdco. So if we were going to go out and try and replace ourselves, it's what it would cost to hire somebody comparable.
And you've been always on the same page with your co-founder Lucas, right?
When you say on the same page, you mean like aligned with that vision of not doing the dividends?
Yep.
Yeah, I mean, we started that way. That was how we formed it. I think he was, I got to give him credit. He was definitely more aligned with it than I was in the very beginning. It didn't make much sense to me, but I've definitely seen the light. It is what allows you to have the flexibility to continue doing those acquisitions and really build something. You know, maybe took a little bit of time. We did not draw big salaries in the beginning, but we were young when we started, and over time, it's provided the lifestyle we need. At the end of the day, we're the owners. We can make that decision. If somebody needs a raise, we just sit down, we talk about it, and we figure it out. You know?
Now, a little bit about the companies you acquire. You said the first acquisition was 3.5 times EBITDA.
3.5 times EBT. Just so you're clear, we don't base anything on EBITDA. So I look at earnings before taxes, or even more carefully. Let's imagine I have a company that has massive depreciation, right? What I want to look at, we probably wouldn't buy that company to begin with, but let's just imagine it made sense to us. What I want to look at is how much of that depreciation do I need to replenish on a yearly basis just to maintain the current business? Okay. So if you got a company, you know, making $500,000 in earnings before taxes, and it's got $500,000 of depreciation, let's just imagine. So no debt. So you say, okay, it's $1 million of EBITDA. I would say that $500,000 depreciation, if I don't want to grow the business, if I just want to keep it exactly as it is, how much do I have to continue putting back in? And then I would figure out a metric of maybe what I truly think that operating cash flow. That's what I'm looking for.
And what has been the average acquisition multiple?
Yeah, we started at 3.5. That first deal. Rule we've followed is we've tried to buy bigger every single time. So the only time we haven't done that is when we bought bolt-on acquisitions. So where we're buying something like we acquired Cinnabon pastry rolls. We acquired the Cinnabon franchise in Panama and we bolted on to our existing restaurant group. Or we bought a steel cable business and we bolted it onto our industrial sales company. Those are the only types of deals we've done that are smaller. We generally are always moving up. As we've moved up, multiples do expand. So the ranges we paid are between 3.5 to 5.5 times earnings before taxes.
What has been the biggest acquisition so far?
In total dollar amount?
Yep.
About 11 million.
And what are I know the other day, or maybe it was even yesterday, you posted on Twitter like 13 questions you ask about a certain company, but what are the main characteristics you're looking growth-wise, numbers?
We like to say that we're industry agnostic. So that means, you know, we're not specifically focused on buying 1, 2, or 3 industries. Okay, we'll look at pretty much everything. There are certain industries we won't look at that I would exclude. And those are going to be, again, businesses that just consume a ton of cash to maintain their business. The most famous of those would be an airline, right? So an airline might have a nice profit number, but they've got to take all that cash and go maintain their airplanes or buy new airplanes just to keep their current fleet going. It's not a great cash producing business. So that would be the epitome of what we don't want to look at. So other than that, we will look at any business. We don't have a hard, fast set of rules saying, you know, I'm looking for specifically a software company in Southeast USA doing double-digit earnings margin, let's say. We don't do that. What we're looking for are just the business economics of the company we're looking at. So for example, restaurants. Restaurants was not a business that we were that interested in. If you would have told me 10 years ago that we would be heavily invested in restaurants, I wouldn't believe. However, a restaurant chain, there were 3 locations, the one that came available in 2016. This is the type of restaurant, I don't know if you have one of these near your house that just everyone goes to. It's just one of those places like grandpa goes with the kids, with the grandkids. It's everyone, you know, from the receptionist to the CEO, they all have been there. They all know it. They all have their favorite plates. It had been around 25 years. It's just one of those local pieces of the economy. Came up for sale. The founder's only rule was he wanted to sell it, but you couldn't change anything. You had to leave it exactly as it was. So he had a lot of groups that wanted to buy it, but he didn't trust that they would do that. So they call us to look at this. And at first it was, we don't invest in restaurants. You know, I don't want to invest in the restaurant that costs $2 million to open, that has the famous chef cooking there, that just has all these moving parts that are very difficult for me to measure. But this company had a price point for the consumer that was very attractive. Okay, so it was anyone could eat there. We knew that people loved it. To open new locations was extremely inexpensive. Therefore, the risk for growth on a CapEx side was reasonable. The production of the food was very much like an assembly line production system. Therefore, it was very repeatable. We saw that we could possibly franchise this out at some point. They use the same types of ingredients in all of their plates. Therefore, I have less risk on inventory waste. There were just lots of these different aspects about this restaurant business that made a lot of sense to us. And that's why we decided to invest. Furniture retail is another one. A brick and mortar furniture retailer in 2021. Most people would look at you going, you're insane. Everyone back then was saying, it's going to be Wayfair and Amazon. They're going to eat your lunch. And why would anyone invest in this industry? It's crazy. We don't love retail either. It's not our bread and butter. But this furniture retailer is located in a part of the United States that is known for furniture manufacturing. It's a commercial destination, so it has great diversification of its clients. 45% of its sales happen out of state, so you're not dependent on a local economy. Its closeness to manufacturers and warehousing allows it to have a much quicker inventory rotation. They rotate inventory 11 to 12 times a year. So you're actually looking at a business that had no debt, great inventory rotation, diversity on its customer base. They had a web presence and were selling about 25 to 30% via the internet. So now that furniture retailer does make sense for us. So again, it's difficult to simply paint with this wide brush and say, this industry is good, this industry is bad. I think it's much more important to understand what is it that makes a business good or makes a business bad. And that's what I was trying to list in that tweet I posted. Customer diversification, supplier diversification, heavy cash flow production, management continuity, stability and revenue growth, length of time in market. These are all factors that as you go putting them together, create a lower risk investment. Now, if you can match that with the correct multiple and a good management team, you've got a pretty good opportunity to do well. It's not guaranteed. As you mentioned before, luck is still going to come into it, but your chances of success, you're just setting yourself up for much more success.
I want to talk a little bit about the challenges and now as you've been operating those businesses for many, many years, how lucky have you been? What challenges have you faced in those specific industries? How have you overcome it?
I would say, believe me, it has not been easy. We're still buying small to medium-sized businesses. These businesses have issues. There's a reason you're getting them for 3 to 5x. And it's because they're not easy, right? No one's just handing you this perfectly oiled machine and saying, go mint 20 to 25% returns off of it without doing any work. So that being said, some of the challenges I can mention that have been overarching, that have applied to multiple companies, have been weakness in accounting and bookkeeping. So generally, you're going to go into these companies and they're going to be weak in that area. We feel we have an edge there because we're very strong individually as partners in our accounting background. We understand accounting. We've done it before. We understand financial statements. So the first thing we do when we buy a company is we're going in and we're implementing our systems in the finance department, how they should be reporting, what dates and times, what checklists they should be following, and our system of reports. Another thing that we've had on the operations side, and I would, anyone buying a business that carries inventory, purchasing is way more important. Even if you think it's important, it's more important than that. Purchasing is part science, but mainly it's an art. And the guy that's been doing it for a long time, if he's been doing it correctly and knows what he's doing, he's got some secret sauce of how to do it. You can try and standardize it. You can try and put a system in. We use software on our purchasing now and started to use a lot more software-based purchasing. But you still need that human element because no software is going to tell you that new project that's coming up in the future, that new client, that client that just left yesterday. You've still got to have that human element in it. Focus on purchasing. Inventory is the place that I've most seen cash disappear. So I would say, when you make your net income, where do you run the risk of that cash disappearing and not converting to operating cash flow? It's in receivables, it's in payables, and it's in inventory. Payables, not so much. It's, you paid somebody early, you lost some cash, but that's not going to be a continuous problem for you. Receivables, if you've got a bad credit out there, this is more of a risk for us in Latin America than in the US. In the US, we've noticed receivables is actually not much of an issue. In Latin America, you really got to stay on your receivables. you'll generally just stop selling to that person. So those things kind of auto-correct. Inventory purchasing, though, that is something that can just completely wipe out your cash position from your net income.
Today, when finishing this podcast, what are you start working on, and how is your day-to-day look like at this in January 2024?
Yeah, I mean, so right now we've got a few things going on, and I would say it's actually a good time to ask it because it's kind of a microcosm of what we do, in different times of the year. We are, if everything goes right, we're about 14 days out from our third acquisition in the US. So we've finished accounting due diligence, we've finished legal due diligence, we've turned the purchase agreement multiple times. We're just on the last final details of the purchase agreement, and we should be signing that in the next 2 weeks. So that will be our third acquisition in the US. Once that's done, it's speaking to investors, calling capital. Whenever you call capital, somebody's not going to send it in. That's generally what happens. Then you have to do some other meetings to raise the remainder of it. So we'll have those meetings coming up in early February. And I also have a trip to Chile in February to meet with our manufacturer of our lubricants. They're actually based out of Spain. It's called Repsol. That's who we distribute here in Panama. And they're having their, America's convention. So I have to go down there and speak with them. I'll go with the CEO and do that trip. And tomorrow I actually have a all-day meeting for, 2024 strategy implementation for our BPO business. So these are things that, like I said, I don't work in the companies, but I do get involved. I do like to know what's going on so it can help inform my conversations with the CEOs. But that's, a couple of days ago, I was taste testing baklava ice cream to start launching in our new, and we have Greek restaurants. That's our biggest restaurant chain we have in Panama. It's Greek pizza. So we're going to launch baklava ice cream. So I was taste testing that. So, I do a lot of different stuff. It doesn't get boring every day.
How much time, if we can put there an hour mark on week-to-week basis, you're spending on each company? Thinking about this, working on exactly on something?
Yeah. I mean, I like to say it like this. I've got the best job in the world because I love what I do. I really enjoy it. And at the same time, it provides me a really nice lifestyle. I get to work with somebody who I really care about and like a lot, my partner. And it also gives me a great flexibility in my schedule. I could be doing this. I'm at my office right now, but I could be doing this from home just the same. So I could be at home. I can be at the office. I can be on a trip. So in that sense, I have great flexibility in my schedule. The flip side of that is there's rarely a moment that goes by that I'm not thinking about this business. So it's always present. And I've had that conversation with my kids and with my wife. I said, on one end, you've got me here. So we've got this flex time, albeit I go to every practice, I go to every game. I'm a very involved parent. My wife needs me for something, I'm there. But there's also moments I'm just kind of lost in space, and it's because my head's thinking about something about the company, or I just got a phone call I had to attend to. So that's the balance. So it's hard to put an hour number on it because literally, generally while I'm awake, it's some part of my head is thinking about the company.
Okay, going back to growing the businesses, what is typical process when it comes to growing a portfolio company? Do you guys prefer organic growth, or you grow through acquisition? How has it been so far, and what you see it's going to be within the next 5 years?
Yeah, so I think starting from the beginning, when we first buy a business and we have that thesis of what we believe is going to happen, it's important to understand that we don't build growth or above normal growth into that thesis. So we are paying a multiple for a company and looking at an operation that I don't need it to grow for the return for the holding company to make sense, correct? After that, growth is going to depend a ton on the CEO. And that's the reality. It's going to depend on the business and the CEO. If we believe a business has excellent organic growth possibilities, and we have a CEO who does not want to execute those, we have a really tough decision to make. It's either we don't do it or we have to change the CEO. And we have to have that conversation and make that decision. If we have a CEO who's gung-ho for growth and we don't really believe so much in what he's trying to do, it's the same type of decision. So a lot of this is just going to be CEO dependent. As far as would I rather organic or would I rather acquisition, I would say we're built for acquisition because that's what my partner and I do. But I would prefer organic. Why? Because the biggest question mark whenever you buy something new is management. The CEO is the linchpin. There's no way to objectively know if that person is going to execute post-transaction the way they have pre-transaction. We think we're pretty good judges of character, and we've had a good track record looking at that, but it's a variable that you're just bringing into the system. Whereas if I have a CEO I've been working with for the last 5, 6, 7, 8 years, I know how they operate. I know their accountability. They know my system. They know what to expect from me. They bring me a growth plan. It makes sense. The returns are similar to what I would get buying something new. I'm probably going to go the organic growth route. Why? Because I don't have that variable. I've already got that CEO in place. If you tell me would I rather do a bolt-on acquisition for one of those companies or buy something totally new and big, I'd probably say I'd rather buy something totally new and big. Because if I'm going to introduce kind of that new company into the system, et cetera, I'd rather it make a difference, you know?
When it comes to finding great people, how often have you been changing those CEOs?
Yeah. So in the US, we have not yet. In the US, all the CEOs are the same as when we bought the companies. In Panama, we have made the change. Again, Panama's been going on for a lot longer. You know, our initial kind of cohort of CEOs each lasted, let's say, over 8 years or 7 years. And then it came to a place pretty much when we were looking to go into the US, we knew we probably needed a bit more professional management running the companies because we weren't going to be 100% focused in Panama. We went out and made that change in our 3 businesses down here to more professional CEOs. The way we recruited them was through word of mouth, local contacts, and we also used headhunting firms to do that. We're pretty slow to make a change at the CEO level, I would say.
Do all companies know that they are under one umbrella?
Yeah, they all know.
Yeah. And do you guys bring them all together once in a while, masterminding, or you keep them separate?
It's something we would love to do, and I think it's on our radar. It's something we do, maybe not. So like I'll do quarterly lunches with the Panama CEOs, for example. We do that. I know they have a chat group together that they'll chat each other for different things that they may need in that sense. Our US CEOs have come down and visited the main office down here in Panama, but we've never actually done a meeting with all of them in the same place. I know it's something my partner's looking at setting up for the next year, 2025.
How many deals are you looking on month-to-month basis, and at the same time, how many failed deals you've had? Like you've put in a lot of effort, you've been doing due diligence, and then you're like, okay, it's not right. Let's not do it.
Again, I think a big definition here is what do you consider looking at, right? I mean, I scan opportunity teasers, hundreds and hundreds and hundreds. I'm doing it every single day, pretty much. We probably look, you know, we read a couple hundred sims, I would say, a year, a few hundred sims that we'll actually read. We seriously maybe talk about, you know, get on the phone with a broker. He and I sit down, we discuss it, kind of take that next step, maybe 50 of them. We only travel up to see, like to visit a company, I would say maybe 3 to 4 a year. You know, that's it. And on average, we're only closing 1 deal a year. So I mentioned before, this is a numbers game. You know, I know it's very popular right now, the whole off-market deal thing. You know, you got to get a deal off-market. I'm not a huge proponent of that. I think use every sort of, if you can find an off-market, you want to send a ton of cold emails or cold calls, great, go for it. But don't not look at broker deals just because they were brought to you by a broker. You know, brokers have the deal flow. Even if you say no to all of those opportunities, it was still going to be beneficial because you will still have seen more opportunities, more companies. It'll get your brain thinking about different ways that businesses can fail. How can they succeed? Understanding different industries, different niches. All of that is super valuable, you know? So that's kind of that filter down. If we can close 1 deal a year, it was a great year. Yes, we've had deals fail at what we call, you know, at the 1 yard line. One of them where it was out of our control. It was a distribution company. We'd gone through due diligence. Everything was fine. In that deal, we were going to do, a lot of times in distribution deals, you do what's called a 2-step close. So, you know, you sign a purchase agreement, everything's agreed to, but then you go and you get your manufacturer approval in a 2-week period. And once you've gotten that approval, then the money goes out and transfer of ownership occurs. And when we went, one of the main manufacturers just said it was not in their power to say we could not do the deal, but they would not insure our distribution contract going forward. Therefore, it just made a lot of uncertainty on the transaction. We had to walk away. And, you know, those are frustrating. But I think the amount of times that we've gone through due diligence, we've had probably 2 that didn't work out. Well, you know, whenever we start due diligence, I firmly believe the deal is going to close.
Now, based on your experience, when it comes to those CEOs and founders, pre-acquisition, post-acquisitions, obviously you decrease the risk by signing a contract and all that. But how has it been for you? And maybe relying on your gut feeling. What I mean in here, that you were talking about, you were talking with a founder, with a CEO. He or she has certain plans with the company, and you felt that, okay, this is a good guy, good person, and then you closed the deal, and then it was first week, and I wouldn't say it was a complete opposite, but it maybe wasn't what he or she was promising. Have you had these type of situations, or to
It's
understand my
happened
question?
once. It's happened once. It's happened once. And it was definitely not a complete opposite at all. The person, honestly, I think the person continued to be exactly who they were. We just kind of assumed that would work going forward, and it didn't. We weren't vision aligned. So what it was it was a true, those people who are just true entrepreneurs. They can't stop starting businesses. That is their passion, is just to create businesses. This person was a true entrepreneur, and they sell a majority stake to us. They stay on running the business, but all they were looking at was just starting more businesses within the company. And each of those was cash draining. And what we're looking at, obviously, was, no, we bought a certain amount of cash flow and we need to produce that, and we have other commitments, etc. So we weren't vision aligned on that. And it's funny because that person ended up going and doing other things and has been super successful in what they've done. And we actually remained partners for over a decade after the fact. So we have a great relationship together. We've been partners in business. He's been a director on our companies. It just didn't work in that moment on the alignment of what we were looking for from the company and his natural state of being, which is to go out and create new opportunities. Other than that, I would say we've been really lucky, really blessed in that the people that we work with, they are who we thought they were. They've delivered on their promise, and that is a huge part of that just art of this. That subjective part of this is really, because people ask us, do you roll equity with the CEO, with the previous owner who's staying on? And the answer is no. We own 100% of all of our companies. We have one business in Panama where our CEO owns, and it's because when he came in, he asked us to buy shares, so we sold him shares. But none of them roll equity. They stay on because it's what they want to do, and they express that pre-transaction. And it's up to us to judge, are they just selling us because they want to get the company sold, or do they really want to stay on? And that comes through in interactions. You fly up there, you meet, you sit down, go on long road trips with them, driving between locations, and it comes out. You can tell if a person is doing this because they have to, or this is them. It's in their DNA to run a company. It's very hard to turn that off after you sell.
Have you bought any companies you didn't know anything about when it comes to the industry? Or how's the process? You find a great company. You mentioned the restaurant business. How do you educate yourself, or how is the process? You find a great business. You're like, numbers make sense. It seems like it's a growing market. Everything is so good, but I don't understand the industry. What do you do? What have you done?
I wouldn't invest. So again, if I can't explain what we do to my kids at the dinner table in 5 minutes, then I have no business owning the business. That's what I would say. So again, I might not know the model number of the oven we're using to make the pizzas, but I understand what we're doing. I mean, we are making salads and pizzas and gyros, and we are providing them to people in an environment that they want to come to bring their family at a price point that they can do it at a high frequency during the month. I like restaurants that people can eat at more than once a week. If it's the place you're going to come to once every 3 months, I'd rather not invest. Value proposition, quality of food, price point, I get that. And I don't think that's going to change. I think people, no matter what, are still going to want to leave their house and go eat good food in an environment they like at a price they want to pay. And they'll want that in 10 years. Therefore, if I pay 4X and I got 10 years to get my money back, I should do fine. And it might really sound simplistic, but that's because it is. Like what we do isn't rocket science. It's quite simple. On the other end, though, it isn't easy. And the part that's not easy is being disciplined enough to say no to all the other opportunities that come across our desk that don't fit every single one of those points. That is the discipline. When we bought our first business in 2011. 1 year later, we bought our second company. And we were actively looking for a third acquisition. I'm talking going to meetings, 3-4 times a week to find companies. We didn't do our next big deal until 2016. We went 4 years without buying anything. And that wasn't because we didn't see opportunities. That was because they didn't satisfy what we were looking for. That's the discipline. Then we went 2 more years only doing bolt-ons. And then it wasn't until 2021 that we did our next major acquisition. So if you look at it from 2012 to 2021, we did 2 major acquisitions. And that's a lot of no's. That's a lot of and you're still looking all the time. You're still believing you're going to find the right opportunity. That takes a lot of faith in what we're doing to believe you're going to eventually find it.
Where did this discipline come from? I mean, 5 years not doing a deal. This is a Warren Buffett level,
I think the benefit is we did have the operating companies going on. So you're still learning, you're still tracking, you're still trying to tweak and improve what you've got. So it's not like you're just sitting on your hands literally doing nothing and you're not seeing any type of growth. You're accumulating cash. You're building a cash position. That cash position is an option on future decisions that you're going to be able to make, future opportunities you're going to have. So you're in your head saying, well, it might take me 4 more years, but when that day comes, I'm going to buy something a lot bigger than I could have had the opportunity presented itself just 6 months after our second acquisition, right? That helps a lot. I would say if I go back to the beginning of all of this, when we started, I always enjoyed investing. I don't consider myself as much a business. I do consider myself a business owner, but not as much as I consider myself an investor. What I enjoy is investing. And what I found in building a holding company is a niche of investing that favors me emotionally, right? So I'm not the best stock investor. I'm not great with daily up and downs. I just put my money in the S&P 500 and I forget about it. But I enjoy the operations of a company and being able to influence the outcome much more than maybe say buying commercial real estate. That there isn't enough to do there. It's just a bit too passive for me, for my personality. Therefore, I've been able to find this niche that I can operate in and do what I really love, which is investing, and have it actually play to my strengths. And I think that's super important to anyone getting started in this, because again, even if you say, I want to go build a holdco, there's lots of different ways to do that. You can go horizontal, buying things in different industries. You can go vertical, doing a roll-up strategy. You can do minority stakes where you're just more passive on the board, adding value. There's lots of ways to do this, even this niche of investing. There's lots of ways to do it. You got to find the one that favors your strengths and your interests.
You answered this a bit, but maybe there is something more to it. Knowing what you know today, what you wish you have known when you started in 2011, and it can't be this insane patience, insane discipline. It has to be something else.
And I'll probably say this in 10 more years looking back to today. No matter how important I believe cash flow is, every 6 months I'm reminded of it again, of how much more important it is than I even was aware of now. If I could go back then, I would have been even more laser focused on cash flow production, inventory purchasing. We made mistakes along the way. We bought inventory that became obsolete, that didn't work. We sold on credit that didn't get paid back. We knew cash flow was important, but we didn't have the appreciation we have today, a decade later. And anyone out there, really focus on the cash. There's some stat, it's like 80-something% of businesses go out of business because of cash flow. That's what gets them. So it's more important even than somebody who believes it's important. It's levels more important than that.
Rafael, what moments in your career do you consider the most rewarding or memorable?
Yeah, I definitely, each time we bought a company has been memorable. I will say that. So each time I love that moment, kind of that when you sign it. Now it's a little less emotional because now everything's done on DocuSign. So it's not like sitting there with the pen. Now you just click a little DocuSign link and it's over. But it's still a highlight. I would say that would be one. So, obviously. And then the second one was when we formally entered into the United States. We were able to raise the capital outside of, we built Panama, just the two of us. And while we had a high conviction in what we were doing, I think raising outside money, having people give us capital to invest, it validates what we're doing. So when we did that first acquisition in the US and had actually entered a new market using other people's money plus our own, all of that was exciting. It was a validating moment.
Have you had any acquisition offers on holdco level?
No,
No.
no, no. I mean, we have people who have spoken to us and who are interested in taking a piece of Panama. So they have never offered to buy the entire thing, but they have wanted to come in as minority owners and take a piece of it, and we've never entered it.
So a little bit about the future. What motivates you today, and what do you want to accomplish next?
Right now our focus is mainly on the USA. I mean, I still pay a lot of attention in Panama. I'm obviously the managing director here, and a lot of it is continuing to build the businesses that we own here and really making them to continue to be better businesses. But as far as outsized growth, it's in the US. We see that is where larger and larger acquisitions are possible just because it's a much more dynamic economy. So, our goal right now is to finish our deployment. If we close this deal at the end of the month, we'll be about 3/4 of the way there of the money that we raised to deploy. So once we finish that deployment, our plan is for 5 more years, continue doing acquisitions with organic cash flow, pay down some debt, and then it would be a public listing for the US holdco. So that's kind of the next, call it 7 years out of what we're seeing. And at that point, I'll kind of reassess and decide what I want to do from there. I know my partner wants to keep getting bigger and bigger, so that's probably where we'll end up.
How has entrepreneurship and building your holdco changed your life and changed your family life?
Yeah, again, I mean, I mentioned before, having that flex time, having that control over my schedule has been invaluable. Being able to be there, very present. I'm married, I have 3 kids, and just being able to go to all of their events is huge. I think that's been hugely beneficial. And on the other side, my oldest is 9 years old. I'm really grateful we bought the pizza and salad restaurant business because that's the one that they love. They love that even more than Cinnabon. So they just love going there, eating there. And he really likes asking questions, really understanding how that business works, understanding the difference. Like, well, if I buy this pizza for $12, does that mean they just give you the $12, Dad? And it's like, no, because you have, you got to buy the dough and you got to pay the electricity. And you got to walking through those real life experiences with him as we're eating is a lot of fun. My daughter's is only 3, so she's just more interested in getting to dessert, and that's about it. She doesn't ask many questions, but my son is into it, so it's been a lot of fun in that sense. Then obviously the partnership, with Lucas, just as far as on a life basis, not only do we work together a lot, spend a lot of time together, but we're friends outside the office, so that's been a huge part of it.
Does your son brags at school that his daddy owns this restaurant?
I don't know if he brags about it, but I know he complains when he goes to birthday parties if they have a different kind of pizza. So at least I raised him well to be a big proponent of our brand.
Okay, Rafael, let's wrap up with the famous 5. It's been a lot of fun. How old are you?
I'm 44 years old.
Favorite book?
My favorite book is Zen and the Art of Motorcycle Maintenance. But I'm going to give an asterisk to this one. And here it is. I didn't actually love it while I was reading it. While I was reading it, I didn't really enjoy the book all that much, the reading of it. But it is the book that is most stuck with me after the fact and has influenced how I raise my kids, lessons I give, how I live my life. There's a theme in that book. How you do the smallest thing influences how you do the biggest thing. Truly quality of work in everything is the goal. And I just think it's such a powerful lesson and the way it was written really stuck with me. So whenever I'm asked that question, that's the book I always go back to. But I will give the asterisk. If somebody goes and buys it because they heard this, I didn't really enjoy it as I read it all that much. It was okay, but it stuck with me.
What car do you drive?
So I drive a GAC GS8. I don't know if you know what that is. That is a Chinese SUV. So the Chinese auto manufacturers have made a huge push here into Panama. I dipped my foot in the water and decided to try a Chinese SUV, and I love it. It's great. I love it.
What's the best investment advice you've ever got?
Yeah, so it would definitely be Howard Marks. Howard Marks is an amazing investment thinker, and it's that risk is a function of price. I think that is so critical. Ken Fisher, who I worked at before, said something very similar, which was great business can be a bad investment at the wrong price, and a horrible business can be a great investment at the right price. When you can really get that internally and understand that, I think it helps everyone. Because sometimes people just say, oh, well, this is a great company. It must be a good investment. Well, depends on the price you paid. And a huge part of what we do in the discipline of what we do is just respecting how much we'll pay. We've seen a lot of great companies and they want 10x, and I'm not going to pay that because I'm not here to make 10% a year. And that means I need to grow the heck out of it or operate it way better than they did to make my returns. And I don't have enough confidence in my ability to do either to go ahead and do that. Therefore, I just respect my price multiples and I continue going forward.
Okay, last one. Where can people find you?
Yeah, so I am at Rafa Quinn, RAFAQUINN on Twitter. That's about the only place. Or alternativeholdings.com if you want to see what our business is doing and what we're buying.
Perfect. Again, thanks a lot for doing this. I was just asking all the questions I had on my mind and all the questions from the preparation, and you didn't really hold back. You gave all the experience, you gave all the knowledge you have. Thanks a lot for that.
No, this has been an absolute pleasure. It's been a lot of fun. This is the first time I've ever done this, so I enjoyed it. It was a lot of fun. It was a great conversation.